Good morning, everyone. You're very welcome this morning to our structured finance tax update. So I think we're going to just give it another 20 or 30 seconds just to allow a few more people to join. Okay, I think we nearly have a full house, so we'll kick off with a few introductions. So Kieran, if you just move to the next slide. So my name is Patrina Smith and I'm a partner in our financial services tax practice. I lead our structured finance tax practice and I also sit on our leasing team. And I'm joined this morning by Kieran Conroy, another of our financial services tax partners. And like me, Kieran sits across our structured finance team and our leasing team. And we're also joined by Keith Lockman, another financial services tax partner, who's a partner in our VAT team. So we have a lot to talk about this morning. It was a very, very meaty finance bill. And aside from that, there's a number of draft EU directives and other initiatives at various stages in the legislative and consultation process. So we'll talk a little bit about those at the end, but we'll focus first just on the finance bill. So Kieran, if you can just move to the next slide. On the next one as well. Yeah, so as I said, a very, very significant finance bill. Firstly, we had the legislation implementing BEPS Pillar 2 into Irish domestic law. Now, I've been working in tax for 20 years, and this is by far the most significant tax change that I have witnessed. It's a fundamental change to our tax system. We also had legislation implementing outbound payment rules. So this was a commitment that Ireland made as part of the Recovery and Resilience Programme, where we received EU funding. So we have the draft legislation and the bill implementing this, and Kieran is going to go on to talk about that in a couple of minutes. We also had legislation relaxing a little bit the rules on interest deductibility for qualifying finance companies, and we'll also touch on that briefly, and then a few other technical updates and those various EU directives as well, draft EU directives that I mentioned. So Kieran, let's move to the next slide. Okay, so BEPS Pillar 2. This is a reform that was agreed in principle at OECD level in July 21, and the draft EU directive was published late last year and agreed by all the member states. So we now have in our finance bill the implementing legislation with some tweaks that just appeared at the committee stage amendments. Now, this is an extremely complicated bit of legislation. It might sound straightforward to describe it. So what it's providing for is a minimum effective tax rate of 15% on profits in each jurisdiction, but the detail of it is actually quite complicated. So the rules apply where you have a single entity or a group with a turnover of more than 750 million in 2 of the last 4 years. And how we define a group for this purpose is really looking at what's consolidated for financial accounting purposes. And that could be under US GAAP or IFRS or a whole other rake of accounting standards. And it's part of a move that we can see in legislation to move closer to accounting. So how the effective tax rate is calculated, it's calculated on financial accounting net income or loss, which are all accounting concepts, but with some various adjustments detailed in the legislation. So what we'll see is Pillar 2 being in force for accounting periods ending after 31 December 23, and our first returns and first payments of any top-up tax due in 2026. Now, Pillar 2, I think initially when it was mooted, it was thought there may not be that many of our client base in scope. But actually, when you get into the weeds of it, I think there are more clients impacted than maybe initially envisaged. There's more consolidations and also some US GAAP consolidations that we may not necessarily have been cognizant of here in this side of the water. But there are quite a number of groups that are impacted. So Kieran, you might just move on to the next slide. So then just looking at the application of it. So just simplistically, I think the assumption was that a Section 110 company, when you look at it, it's only taxed on a small margin and it's taxed at 25%. So the effective tax rate for that Section 110 company is 25%. So that's above the minimum 15% mandated by the directive and by the legislation. So potentially no top-up tax, but it's not quite as straightforward as that. So your income for Pillar 2 purposes is calculated on your accounting profit, not your taxable profit. And it's calculated on your consolidated, on the profit that's used to comprise your consolidated financial statements, not necessarily your standalone financial statements. There's also a number of adjustments that the legislation outlines. So it's not necessarily as simple as saying, well, look, I have a profit of 1,000 and that's taxed at 25%. So I have an ETR above 15%. It is a little bit more complicated than that. And we are getting into the weeds of it at the moment for many clients. And I think there's a job of work to do really to come out the other side of that. There's a number of safe harbors that the legislation provides for, which may be quite useful. But again, those need to be worked through. So there is a safe harbor around CBCR. So it's possible to use CBCR data. Now that's assuming that the CBRC data is accurate. So that's potentially work to be done initially to make sure CBCR data is accurate. And that'll look at certain de minimis thresholds for some companies, but also allow you to calculate the ETR based on of CBCR data, which is just a little bit more straightforward and gives impacted groups where they qualify just a little bit of leeway in terms of all the onerous calculations that'll need to be done, but that will only apply up until 2026. So we can move on to the next slide and Kieran is going to pick it up.
Cool, thanks, Trina. So good morning all, and I'm just gonna, I guess, talk a little bit about the roadmap now from a Pillar 2 perspective in terms of between now and year end, and then what's happening post year end when the rules are actually live. So I guess between now and year end, what taxpayers should be thinking about and I suppose assessing from a Pillar 2 perspective is making sure they've done kind of an impact assessment, including, the safe harbors, as Petrina mentioned, in terms of the impact that the rules could have on their structure or entities across the different jurisdictions. And also, that is going to be particularly important. So completing dry runs of Pillar 2 reporting and disclosure processes ahead of the Pillar 2 go live, I guess, in 2024. So that's kind of it's kind of a readiness piece between now and then in terms of assessing the impact and what that might be and what the related obligations are going to be. In 2024, first of all, we're obviously going to be thinking about the audit of the 2023 financials. There's no reporting required or provision required for Pillar 2 in 2023 because the rules aren't applicable for 2023. However, there are disclosures required in the financial statements for 2023 in relation to Pillar 2. And broadly speaking, that those disclosures are around information that helps users of financial statements understand the entity's exposure to Pillar 2 taxes. That's broadly speaking what the disclosures are around. So for 2023, we would need to disclose information such as the jurisdictions where an entity may have a Pillar 2 liability, an estimate of the profits that may be subject to Pillar 2, and an overall estimate of the potential impact on the effective rate of the entity from a Pillar 2 perspective when the rules come in. Some of that information can be in the form of range at that stage in the disclosures, but there is a requirement to kind of disclose an overall assessment of the position from a Pillar 2 perspective in the 2023 financial statements, even where you're not providing for tax in those financials. Moving into other obligations, I guess, in 2024 and 2025, and I guess a key date here will be March, April 2024, which we have underlined there. Pillar 2 is included in the tax provision, quarterly tax provision for the first time. So for those doing quarterly reporting, that's the first, I guess, provision we'll need to make for Pillar 2 in our accounts for tax purposes. So for those doing quarterly reporting, that's I guess a key date. Pillar 2 obviously flows through the other quarters, the other Qs in 2024 and 2025. and the year-end audit as well obviously needs to include that provision. So being ready for that will obviously be key. In 2026, those quarterly reports obviously continue, but also in 2026, as Patrina mentioned, we have a key date in June 2026, which is the first filing deadline for Pillar 2 tax reporting. So that is 18 months after the first year end at the end of 2024. That's actually a relaxed deadline of 18 months. The standard deadline after year one will be 15 months, but the deadline in year one is an 18-month deadline. So 18 months after the year end of 2024 gives you June 2026 for your first Pillar 2 reporting deadline there in that year. So 2026 obviously a key year for reporting on Pillar 2. So that's just some of the roadmap in terms of reporting and what we need to be aware of and be ready for from a P2 perspective. In terms of tax planning and what we're looking at with clients as well around different transactions and basically anything that might impact on our Pillar 2 position. So we've just listed here some of the key, I guess, considerations in the context of any new transactions that we're doing. The 750 million threshold is obviously key. So does anything we're doing now impact on our analysis around the 750 million threshold? If we're planning any transactions, any restructuring, does it impact on that, or whether or not we're in scope of Pillar 2? The safe harbors, does anything we're doing now impact on our safe harbor analysis around Pillar 2? As Patrina mentioned earlier, that's really important in terms of the CBCR safe harbor or the other safe harbors that anything we're doing now needs to be, I guess, look through that lens in terms of how it impacts on us. Also, the upstream impact, which we may not have considered before, but what we do at kind of an Irish level may impact upstream, where we have an IIR, an income inclusion rule, or a UTPR might be applicable as well. So just to bear that in mind. The domestic top-up tax. So this is really a new tax payment requirement for us. So is something we're doing now potentially going to impact on our qualified domestic minimum top-up tax that we have to pay? It's obviously a new and completely new initiative or a new issue for us to consider from a tax perspective, as Patrina mentioned. So important, I guess, to bear that in mind in any of our planning now as well. And finally, ETR assumptions. So broadly speaking, around the transaction or restructuring we're doing, if we're doing something, we need to determine what is the impact of that potentially across multiple jurisdictions, if there's multiple jurisdictions involved, and what's the Pillar 2 impact of that across all the jurisdictions that it kind of touches on. So they're kind of some of the key considerations from a planning perspective in the context of Pillar 2. And they'll need to be confirmed for the purpose of internal approvals, and also from an audit perspective as well, to make sure that what we know the impact of what we're doing from a Pillar 2 perspective. That's all on the Pillar 2 stuff. I just wanted to move on to speak a little bit about the outbound payments legislation as well. So outbound payments legislation was also included in the finance bill. Broadly speaking, as I think Patrina mentioned earlier, it was part of Ireland's National Recovery and Resilience Plan that the government made a series of commitments to tackle aggressive tax planning. All of those commitments have been, I suppose, legislated for, with the exception of one, which is legislating for outbound payments. So this is the final measure, that's required in relation to that plan, and it's part of our legal commitment as well to secure funding under the National Recovery and Resilience Facility agreed with the EU, as arising from the COVID-19 pandemic as well. So that's kind of the backdrop to why these rules are being introduced. So at a high level, what are they saying? They're basically new withholding tax rules for interest, royalties, and distributions. And they basically disapply withholding tax exemptions in certain circumstances. So your standard withholding tax exemptions are disapplied where these outbound payments rules apply. And broadly speaking, what they're trying to capture is payments of interest, royalties, and distributions to associated entities, and that's important. The entity has to be associated with the Irish entity or PE, and it also has to be in a zero tax or a non-cooperative jurisdiction. So zero tax is fairly self-explanatory. It's where the income is taxed at a rate of a nominal rate of zero, or non-cooperative jurisdictions, which is a specific list that the EU publishes at that level, and that is updated regularly with regard to non-cooperative jurisdictions. So zero tax or non-cooperative, you fall into this category, and to the extent you're also associated, um, the rules may be applicable here. And we'll talk a little bit about some of the exemptions from that, or some of the um, mitigating factors that could apply as well. But that's broadly the rule. The legislation will apply for payments made on or after 1 April. So that's when the rules apply. However, there is a grandfathering provision, effectively, for arrangements in place before 19th of October, which is the date that the finance bill was published. If your arrangements were in place on or before the 19th of October, the legislation doesn't apply until January 2025. So there is some lead time there in terms of thinking about how the rules might impact, and thinking through how basically you deal with that across any interest flows, royalty flows, or distributions that may be in scope of these rules. Moving on then to, we have a short flow chart here just to show exactly that, I guess, the steps we need to work through to determine the impact of the rules. So the first point is that we do need a payment of interest, royalties, or a distribution by an Irish resident company or an Irish PE. If we don't have that, then the rules are not going to be applicable. And in relation to interest and royalties, we do need to be taking a deduction for that payment in order for the rules to be applicable as well. But in most cases, certainly in a from a structured finance perspective, interest payments, we will be looking to claim a tax deduction on those. So they will be in play we will be potentially in scope of the rules in relation to, particularly from a structured finance perspective, we'd be concerned with interest and also with distributions to a certain extent as well. If we don't have a payment, then obviously the rules don't apply. If we do have a payment, then we need to determine if it's a payment to an associated entity, and that's really important. So there's a specific definition for associated entity. Broadly speaking, it's a 50% relationship through shares, through profits, through voting rights, and it can also be through another entity owning or owning having a 50% owning relationship effectively with our company, and another company could also make us associated through a third entity, basically. There is also a concept of definitive influence, which if one entity has definitive influence over another, they can also be associated for the purpose of this. The definitive influence definition is broadly similar to what we would have had for the hybrid rules. It's focused on a representation on the board or governing body of the entity as well. So we'll be familiar with that type of definition from the hybrid rules previously. But just important to bear in mind, it must be a payment to an associated entity before we even get into potentially looking at a withholding tax issue here. So if it's not associated, the provisions don't apply. So no issue. Moving on then, if it is a payment to an associated entity, next step is to determine, is it a payment to a specified territory? And as I mentioned before, a specified territory is generally a zero tax jurisdiction or jurisdiction listed on the EU non-cooperative list. So, and then just to bear in mind as well, that includes, entities that may not be resident in a specified territory, but are effectively, like, for example, a partnership in the Cayman, for example, would be an example of an entity established in a specified territory. That still counts for the purpose of these rules, even though the entity isn't technically resident. If it's established in a specified territory, that is also caught by these rules. And we can talk a little bit about partnerships on the next slide as well. But basically, if it's not a payment to a specified territory, then that's a no. So we're back into provisions will not apply. So again, has to be associated and has to be paid to a specified territory. If it is a yes and we're into specified territory, then the provisions apply, subject to certain exceptions, which I'll come to. But that's the basic rule. If we click onto the next slide, there's a couple of other points to bear in mind here. So particularly from a structured finance perspective, there's a few points to be aware of here. It's not always as straightforward as payment to a specified territory, associated means you're in the outbound payments rules. There's a few different other things to bear in mind. So the first one is, and particularly for structured finance, this may be relevant. There's a concept of corresponding payment in the rules. So a corresponding payment within 12 months of the end of the year in which the payment is made to a third jurisdiction counts as what's called or is defined as a corresponding payment. So how would that work? That would be where Ireland makes a payment to a specified territory, which will be within the ambit of the outbound payments rules. But that company onward makes a corresponding payment to another jurisdiction, which may not be a specified territory. And if it qualifies as a corresponding payment, in other words, if the recipient, let's say it was interest, if the recipient of the interest onward pays it up to another territory and it qualifies as corresponding payment, then that payment can count as a payment directly from Ireland to the third territory. And I guess the impact of that is that the rules, whilst they might have been relevant on a payment direct to the specified territory, they may not be in play in the context of a payment directly to the third territory if that was not a specified territory. So it's dealing with a situation where you pay to an entity, but it's really an in and an out, that entity receives the income and onward pays the income out to a third jurisdiction. So the payment is deemed to be made to a third jurisdiction for the purposes of assessing the rules in that case. I mentioned partnerships already. Second point here is on partnerships. There are provisions in the outbound payment rules to look through to partners in a partnership. That's where each of the jurisdictions involved, in other words, the recipient jurisdiction of the partnership. So if you take, let's say, a Cayman LP would be in a specified territory, because it is as an entity formed in the Cayman in a specified territory. If that's looked at from a Cayman perspective as a partnership, which it will be in most cases, and the partners also look at Cayman as a flow through, then provided the partners and Cayman look at it as a flow through, as a look through, then the rules provide that you can look through it from a outbound payments perspective as well, which basically means that, again, where we make the payments to a partnership, we look through the partnership to the partners to determine whether or not we're associated, first of all, and also whether or not they're in a specified territory. So that could result in a scenario where we have a payment to ostensibly to, for example, Cayman, and maybe a Cayman LP, but that is considered to be arising to the partners, and the partners may be in the US or Canada or Australia or whatever, and they're taxable. Then that could present us with there could be I guess an out for that type of payment from the outbound payment rules on the basis that in reality the payment is going to the partners in the partnership and not to the partnership itself, which makes sense. There's also a knowledge-based test, again relevant for structured finance, particularly for quoted Eurobonds. It's dealing with a case where you have listed debt or wholesale debt, and it's reasonable to consider that the company is not aware of any associated entities in receipt of a payment. So where you list the debt and you effectively don't really, it's not reasonable for you to know exactly either the tax status or the association status of the note holder, because it's listed on a public exchange or whatever. From a quoted Eurobond perspective or wholesale debt, then there's a kind of a reasonable to consider clause there in the legislation that says you don't necessarily need to apply the outbound payments rules where it's reasonable to consider that the payment is going to non-associated entities that are not associated with the payer. And the final point here to make around dividends, and this is, I guess, an important one as well. The whole point of the rules was around dealing with double non-taxation. So it was dealing with aggressive tax planning and double non-taxation. So where a distribution is made from income that has been subject to tax already in Ireland, directly or indirectly, the distribution will not be subject to the rules. So if, as an Irish company, I make a distribution to a specified territory and I'm associated with that entity because it's my parent, but that income has been subject to tax in Ireland, which in most cases it will have been, the rules don't apply because again, it's focused on this double non-taxation piece. There's also the provision there includes indirectly. That also that deals with a situation where we have Irish company Irish company and then a specified territory above. So if you have a dividend from Ireland to Ireland, for example, and that was franked investment income into the parent Irish company, not subject to tax in Ireland, but the underlying profits from which the dividend was paid in the lower tier subsidiary was taxed, then the rules also wouldn't apply because there's an indirectly clause in there. So ultimately, it's looking at for distributions, you need to think about, was the income from which the dividend was paid subject to Irish tax originally, be it directly in the company it's paying or indirectly below. It's just important to bear in mind that, particularly in the context of dividends. And I have just a couple of examples here that I'll briefly run through. One is a very straightforward, just thinking about this from a structured finance perspective. We have a Luxembourg note holder, we have a Section 110 company holding assets, and the Irish company makes a payment to the Luxembourg entity under a PPN, so an interest payment. Obviously, that interest payment is to, if it's owned by the Luxembourg note holder, it's an associated entity, but Luxembourg clearly is not a specified territory because it's not a zero tax territory. So that payment would not be in scope from a outbound payments perspective because it's paid to Luxembourg, which is not a zero tax territory. That's a fairly straightforward example. A scenario here where we have a Section 110 orphan vehicle, its equity is held by a charitable trust. There's a Cayman company note holder under a PPN. So we're paying, there's an interest flow here between the Irish Section 110 company being an orphan vehicle up to the Cayman company note holder. So first of all, the first thing we need to consider is, are we actually associated with the Cayman company note holder? Because if we're not, then the rules don't apply. So Cayman obviously is a specified territory, but the key point is if we are orphaned, and bearing in mind that the definition of definitive influence that I mentioned earlier around association is similar to hybrid, then to the extent we're not associated with the Cayman company note holder in this case for hybrid purposes, albeit we'd need to check it specifically. There's a reasonable chance that we won't be associated here either for outbound payments purposes. So it's an important one to kind of assess from an association perspective. We know Cayman is a specified territory, but if we're not associated, the rules don't apply. So that definition of definitive influence is quite important as well. But again, it's pretty much consistent with what we would have seen for hybrid purposes. So that's the kind of Cayman company note holder example. And then we have quoted Eurobond here as well, which again, Orphan 110 holding assets, equity held by a charitable trust, as I'm sure you'll all be familiar. Note holders in various, could be third party, various note holders in different jurisdictions. It's a listed Eurobond. There's a practical difficulty here associated with determining the association status and also the tax status of the various third party investors, because there obviously could be multiple. And this is a point we raised, I guess, on multiple occasions throughout the consultation process for these rules, which we were involved in, around the practical difficulties with this. But as I mentioned earlier, the knowledge test we have that I described earlier would be relevant here in terms of if it's reasonable to consider that the third parties that hold the notes here are not associated with the Irish company. That obviously is of practical benefit to us here from an outbound payments perspective, in that we can look at it and say, well, it's reasonable to consider that these third party note holders aren't associated, and therefore the rules shouldn't apply. So they're just some, I guess, practical examples of from a structured finance perspective that we'll come across day to day. And they are key. Like the outbound payments rules are key changes, obviously, for structured finance, structures and entities, and particularly where you have interest in dividend flows, we will need to take those into account and bear them in mind in the context of new and existing structures as well. So a key change, but one that we just need to make sure that we're across the impact across all the structures, particularly in line with that grandfathering provision until the end of 2024. So with that, I'll pass back to, I think, Patrina, you're going to cover the qualifying financing companies, which is in the bill as well.
So, and just on the outbound payments, just to point out that all structures will have to be reviewed to see what the impact is, just as they were for the hybrid mismatch rules and interest limitation. So moving on to talk about qualifying finance companies. So this is a new concept and a welcome development introduced in the finance bill. So what it's trying to achieve is where we have, say, a holding company that's borrowing and lending to subsidiaries, that there's an interest deduction allowed for that holding company. So previously, in order for the holding company to obtain an interest deduction, it had to be carrying on a trade for tax purposes. So the interest had to be incurred in the course of the trade. Or there were some very complicated rules around Section 247, which is referred to as interest as a charge, which will allow a deduction as well, sometimes in a non-trading context. But there are some onerous conditions for those rules and actually some also very complicated anti-avoidance. So really, historically, the preference was to try and come to the view that the holding company was carrying on a trade for tax purposes. Now, in many cases, actually, we did come to that view. So the impact of these provisions may be limited, but I suppose they are nonetheless welcome. So in order to qualify as a qualifying finance company, the finance company has to borrow from a third party and has to lend to a direct 75% subsidiary, and that 75% subsidiary has to utilize that loan in the course of its trade. So what this will do is just where the holding company is taxed under case 3 or case 4, so it's non-trading or passive, it'll allow an interest deduction provided these conditions are satisfied. Now, as I said, it's got quite a limited impact. And just to set the context, there has been really some pressure for the Department of Finance and Revenue to more generally review the rules on interest deductibility. So it makes no sense that interest can only be deducted in the course of a trade when other types of expenses are not subject to the same restrictions. So interest, in our view, should just be treated as a normal business expense, just like any other. It shouldn't be that interest deductibility is limited to where it's incurred in the course of a trade. Makes no sense. And also, there have been many layers of rules now superimposed one on top of the other around deductibility of interest. So now we've interest limitation rules on top of a whole rake of other rules that we've had historically. So I think there does need to be a review of all of that and to remove some of those maybe old provisions that really don't have any impact and really aren't business focused. They're just historic. So we'll be continuing to advocate for a simplification and a relaxation of the rules around deductibility of interest. But a somewhat welcome development in the bill, the legislation around qualifying finance companies. And I think it was aimed really at the leasing sector, or that was the sector that was in mind when this was drafted, but it could have broader application. So then, Kieran, just moving on, and I'll hand over to Keith for the VAT update.
Yeah, thanks, Patrina. Thanks, Kieran. I suppose just really wanted to touch on some VAT developments, and I will literally touch on them just to create a bit of awareness. But I suppose as we see towards the end of this, a bit like the world we have now in direct tax, where we're looking at the fundamental changes and the biggest changes that I've certainly seen in my lifetime, we're also on the cusp of some major VAT changes that we're going to see over the next few years. So I just wanted to bring those to life. But at a high level, there would have been quite a lot in relative terms for VAT in the finance bill this year. However, a lot of it is probably not overly relevant to the world that we occupy. But I wanted just to touch on a couple of challenges and reminders that I wanted to highlight today. So the first one that probably would have seen around general media and certainly on budget day, etc., would have been this great announcement that the VAT registration thresholds have changed, have gone up by 5,000 or 6,000 euros, whatever. Just to highlight that really, in practical terms, that has little or no relevance to the world that we occupy in terms of financial services, structured finance. For our business, the threshold for VAT registration, I would just remind everyone, is nil. So the reason the businesses in this space will be VAT registered is because we are in receipt of services from overseas. And for that, there's a nil threshold. So a €1 of a service, a legal service, etc., is enough to bring a VAT registration requirement and VAT compliance obligations. And I guess, practically speaking, this is a real challenge for ourselves in this space, because obviously, as we all know, so much effort goes into getting a transaction over the line. Very often the administration can be a little bit slow in following that down. So just bear that in mind, that nothing has changed, and not to get caught up in the hype in general media. The second point, which it's typical of maybe a lot of tax changes, and particularly a lot of VAT changes. At first blush, you kind of go, what was that all about? But when you start to lift up the stones and look at it, there may be some VAT issues, probably unintended, and we're currently in discussions with Revenue on this one. But just to highlight that, prior to the finance bill, we had a VAT exemption, so you don't charge VAT on the issuing, transferring, and dealing in stock, shares, debentures. So the type of stuff that we're involved in. The finance bill has removed the word issuing, so that going forward from January, the exemptions would be for transferring and otherwise dealing in stocks, shares, debentures. And you kind of ask yourself, okay, what was the reason for removing issuing, and does that have any impact? And certainly, to be fair to Revenue, I think the word removal of issuing is probably a tidy up, because there are cases within Europe that have said, look, the issue of shares, not to get overly technical, isn't VAT exempt, but it's not subject to VAT. So it's a bit of a tidy up in legislation. However, when you do look at it a little bit more, it does raise some questions that we would have over how one might tax a share for share exchange, perhaps a bonus issue of shares, or those type of transactions, because historically Revenue would have said that they were VAT exempt. Now, by removing this clear exemption, those type of transactions would potentially be within the scope of VAT. Now, I don't think that is intended, and that wouldn't be consistent with European law, so it wouldn't be panicking just at the moment. And we are in discussions with Revenue on that, who have said that they don't believe it changes their position. But it is a bit of a doubt that's out there at the minute, so we may see some changes, Kieran and Patrina, as this develops over the coming weeks, just to remove that potential issue. And there is a knock-on impact as well in terms of arrangement services, because we would have within Ireland an unusual exemption for agency services in connection with these, and that's something we would have relied on in terms of corporate financier fees, etc. Just removing the word issuing further up legislation has a potential impact on the treatment of those services. Again, we've highlighted that to Revenue. Again, it doesn't appear to have been the intention, so we may see some changes. So I think it's very much a case of, look, there's now a potential issue around this. We need to just tread carefully. We do appear to believe it's unintended, and we may see some changes coming down the line. So just to say, to really bear that one in mind. The final point really wasn't in finance bill as expected, but it was an announcement around the time of the budget, around about the finance bill, and it is critical, and it goes to the point I said at the start in terms of these are the big changes we're seeing in corporate taxes, but we're about to see a lot of VAT, and this is the biggest change certainly in my time in VAT, and it's around modernisation. So some of you will be aware of the recent PAYE modernisation provisions, and we're about to see that now from a VAT perspective. So what we will see is move to a digitisation of VAT. So a move away from the bi-monthly filing of VAT returns that are currently out there to a more real-time reporting. We will see a move away from paper invoices to e-invoicing. And by e-invoicing, I don't mean PDFs. I mean standard electronic type of form invoices, probably to a European standard. So provisions are coming in at European level from 2028, which sounds like a long time away, but many countries have already moved towards that, notably Italy, France, the Gulf states as well outside of Europe. But Irish Revenue have announced in October that they've opened the consultation on this, and that consultation will open until the 12th of January 2024. Well, they want to hear from businesses just in terms of the challenges they would see, what they would see as being the future of VAT reporting. And that is very much the first step in a process. And notwithstanding to say this is coming from a European level, it is very much an intention of Irish Revenue to introduce this across the board in VAT. So it'll not only impact cross-border supplies, it'll also impact domestic supplies, etc. So that consultation is opened. We would encourage everyone to be involved, and we can facilitate that where appropriate. I suppose the word of caution I would have there, Patrina and Kieran, is that certainly for those clients who are considering finance transformations, investment in new information systems, these developments are coming down the line. We don't know what they look and what they feel like at the moment. And what we're saying, so it's just to be aware that we need to have flexibility in that. We need to keep monitoring this and take these into account as we go down the line over the next number of years. But certainly exciting times for business in that terms. But yeah, so that's really it. Just to highlight a few key points, Kieran.
Cool. Thanks, Keith, for that. Appreciate it. And I think we will move on now in the interest of time to, I think there were some other technical updates or other updates in general. I think, Patrina, you're going to take this one, just some other updates, one of which I think was in the bill around the hybrid stuff. And then there's some others just to make our clients aware of in terms of not necessarily finance bill ones, but ones that are in the ether as well.
Yeah. So just the first change, there was a change in the bill around the definition of entity for the hybrid mismatch rules. And this is to make it clear that a partnership that doesn't have a separate legal personality will still fall within the definition of an entity and create an association for the purposes of these rules. I think based on the previous drafting, there was a view out there that a partnership without a separate legal personality couldn't be treated as an entity. But this is Revenue trying to make clear that actually it can be. So I think where there's partnerships, I think it's worth maybe refreshing that advice. Now, not included in the finance bill, but in the mix either at EU level or domestically, there's a number of potentially significant changes. The first one is a domestic initiative, and it relates to Ireland's tax system being a worldwide system. Now, broadly, tax systems fall into two categories. You've got a territorial system, which taxes income arising in the territory and doesn't tax income from outside that territory earned by a resident, or you have a worldwide system of taxation where worldwide income is subject to tax in the jurisdiction of residence. Now, there's very few countries that are purely territorial or a worldwide system, but countries tend to fall nearer one side or the other, and Ireland is nearer the side of a worldwide system of taxation. So what that means in practice is that dividends earned from subsidiaries are subject to tax in Ireland, but there's a credit available for foreign tax paid, or branch profits as well are subject to tax, or gains on disposals of shares in subsidiaries subject to exemptions in certain circumstances. Now, what has happened is there's been a lot of litigation at EU level in front of the European Court of Justice on how foreign dividends are taxed in a number of EU countries, including the UK, which had a very similar system to ours. So as this case law developed and the result was in favour of the taxpayer, Ireland has tweaked its tax credit system on a number of occasions. Now, the UK decided to just abolish taxation on foreign dividends, but Ireland kept moving to change the tax credit system. As a result, we have an incredibly complicated tax credit system, so complicated that it's difficult for me to explain it to another tax advisor. So there's been a recognition of that. So in 2021, there was a consultation process launched around moving to a more territorial system of taxation. So looking at how branch profits are taxed, dividends are taxed, and potentially gains on shares. There was a welcome development in the budget. The minister in his budget speech confirmed that some options were being seriously considered with a view to moving towards a more territorial system. And we're hopeful that we'll see changes in next year's finance bill. So what it might mean in practice for a Section 110 company is that it may be exempt in respect of some or all of its dividend income which we've received. Now, it's not clear that a Section 110 company would be included, but that's certainly what we've pushed for, and it would be a welcome development because, particularly with interest limitation rules, dividend income, while it can be stripped out with a PPN, is not interest or interest equivalent income typically. So it would be a simplification for a Section 110 company, and it would be a very welcome development. I think we'll certainly see something in the bill next year. The next point worth mentioning is ATAD 3. Now, ATAD 3, it was a draft EU directive aimed at preventing the misuse of shell companies. So where a company, where there's certain hallmarks, ultimately treaty relief may be denied in respect of that company. Now, the draft directive has gone through a number of iterations, and there was a compromise text published earlier this year. But at this point in time, there is no agreement yet among the member states in respect of ATAD 3. And the latest we've heard is that the implementation date has been pushed back to 2026. But at the moment, no text has been agreed, and that will require unanimity among the member states. The next development worth mentioning is trace reporting. Now, this relates to withholding tax relief, and it stands for Treaty Relief and Compliance Enhancement. Now, this was originally an OECD initiative, and the OECD recognised that publicly traded securities are typically held through an intermediary or a number of intermediaries. And traditionally, the method of claiming treaty relief or domestic reliefs at source really assumed a bilateral arrangement and just wasn't appropriate where you're holding securities through intermediaries. So the OECD made a number of proposals, including allowing intermediaries to claim treaty relief on a pool basis. Now, the EU has taken up those OECD proposals and issued a proposal in June 2023 for an EU trace type programme. So there's a number of potentially welcome developments that may make it easier to claim treaty relief. So there's a common EU digital tax residency certificate. It's one proposal. There's 2 fast track processes proposed for claiming treaty relief, and then a reporting regime as well to allow member states to verify entitlement to treaty relief. And it's proposed that those provisions will be in place for 1 January 2027. But again, I think early stages with that initiative, it was only published over the summer in June 23. Now, separately and importantly, there's another EU initiative around business taxation. So there were 2 directives published in September as part of this business taxation initiative to modernise business taxation, one of which was the BEPS. So this is the Business in Europe Framework for Income Taxation. And this looks very much like a second go at the CCCTB, so the Common Consolidated Corporate Tax Base. So the CCCTB was an initiative proposed many years ago, and the Commission found it impossible to agree to have the proposal to get unanimous agreement among the member states, so that fell away. So in light of Pillar 2 being adopted by the member states, the Commission decided to have another go at this. And the BEPS it does 2 things. It proposes common rules to calculate tax around Europe, and it borrows many of the Pillar 2 concepts. So again, it's based very much on accounting profit. There's a 750 million euro revenue threshold to be a BEFIT company, but it also has a formula for the allocation of the income among the various member states. This was published in September. So at this stage, it's difficult to know what the appetite will be among the member states. I think the CCCTB, the Commission couldn't get agreement on that. So the same member states that opposed the CCCTB may well oppose the BEFIT proposal, particularly smaller member states who are concerned about their tax base being eroded. And separately, the OECD have also released their formula and their workings for Pillar 1. So Pillar 1, which has been conceived in conjunction with Pillar 2. Pillar 1 is more around the allocation of the taxing as opposed to the effective tax rate. So the OECD have just published their Pillar 1 proposals. There was detailed workings published a number of weeks ago. So I would imagine a number of the member states would prefer to wait and see how those Pillar 1 proposals emerge rather than have an EU initiative separate to the OECD initiative. So again, a wait and see with the BEPS. In September, we also had a draft transfer pricing directive published. So the proposal is for this that it will be implemented by the end of December 2025. So it does a number of things. It's trying to harmonize transfer pricing rules around Europe. So the first thing it does is that it broadens out what's an associated enterprise as compared to Ireland's existing rules. So under our current rules, a 50% interest is required, but under these proposals, it will be a 25% interest. And there's also a concept of significant influence that would create association as well. So similar to what Kieran talked about for outbound payments, a definitive influence and what we've seen in hybrids. So that's one important point. So there could be a broader number of transactions now within transfer pricing rules that previously fell outside because there was no association. And then another important development is that the rules are looking to really push taxpayers to use the interquartile range when there's ranges being prepared for transfer pricing purposes. So currently under OECD rules, if there's a range prepared, anything in that range is acceptable, although we probably tend to stick around the middle. But under these proposals, it's really that middle or interquartile range that the taxpayer will be forced to use. In terms of the directive, it hasn't outlined if there's particular types of transactions that have to be within transfer pricing. So for the moment, for example, the PPN is excluded from transfer pricing. So there's nothing in the directive that would cut across that as currently drafted. But it's definitely a wait and see, and potentially more appetite in the member states to adopt this rather than something as complicated as the BEPS proposal. But again, only published in September. So it's a wait and see with the TP directive. So that's it. There's a lot there.
Cool. Thanks, Patricia. So a lot coming at us even after this bill. Very good. So I'm conscious of time, and there are one or two questions we want to just touch on as well that people have asked. So there is a slide here just on the next steps in terms of the bill and where that's going. So this slide here just on, obviously the bill goes through several stages now. You've got committee stage. We actually just got committee stage amendments there on Monday, so we're assessing those at the moment to assess whether they have any material impact. There you've got report stage in late November, the Shannon stage in late November and into December, and then it's anticipated the bill will be signed by the end of December as well, similar to previous years. So we do have a way to go in terms of it actually being enacted, and we'll obviously be tracking any developments there as it goes through that process. That's just briefly to touch on that, and then finally, I guess we just wanted to touch on any questions that have been asked through the Q&A here. One is, well, we have a couple, I think, on outbound payments. One is around how do outbound payments withholding tax rules affect the quoted Eurobond exemption on listed PPNs? And I think the answer on that one is that generally speaking, we wouldn't expect to be associated with the note holders in a Eurobond scenario. So on listed notes. So on the basis that we're not associated, and bearing in mind that that provision that we mentioned earlier around the reasonable to consider test, on the basis that we're not associated, we wouldn't necessarily need to dig into the tax status of each individual note holder in a scenario where we're not associated. And bearing in mind, as you mentioned earlier, that those association rules are similar to hybrid, so we would have considered it for the purpose of hybrid rules as well. So you wouldn't expect a major impact from a Eurobond perspective specifically. Another question on outbound payments was kind of tiered structures and partnerships, and we do see that a lot as well. And how do we deal with that? Well, if we're paying to a partnership, and if one of the partners in that partnership is also a partnership. You can look up different tiers to get to the actual beneficiary to determine what the status is. So ultimately you're looking to the benefit, the beneficial owner of the income that you're paying up. So to the extent you're paying up, let's say to a Cayman LP, and there's a partner above that in a jurisdiction outside Cayman, you can deem that to be, or you can look at that as a payment from Ireland to the other jurisdiction. And to the extent that that partner is also a partnership, you can also look to the partners above that to determine the status for assessing both association and in terms of determining the tax status of that investor as well. So that I hope that helps on the outbound piece. And there was one question as well, Patrina, on the Pillar 2 stuff, and just in terms of what are we looking, what are we doing for clients now in terms of Pillar 2, in terms of the assessment and readiness for 2024 in terms of P2?
Yeah, so I think Pillar 2 and the work around Pillar 2 has really taken off over the last number of weeks. So we are now doing a number of impact assessments for clients, and that involves looking at what the ETR is. So there may have been various assumptions made about the ETR, but does that really hold good in practice? Looking at whether any of the safe harbors apply, but also drilling into the accounting treatment to see whether there's whether entities are actually part of an M&E group. So as I mentioned before, a US GAAP consolidation counts to create an M&E group. So you could, in theory, have an orphaned entity that's consolidated and it's part of an M&E group. And then I think the other thing just to watch out for, which we're reviewing as well, is partially owned entities can be sucked into Pillar 2. So where there's a minority interest that's consolidated, it doesn't have to be a full consolidation with a parent entity. That can suck an entity into Pillar 2, and likewise JV type arrangements, where one of the JV partners consolidates the lower entity, that can also create a Pillar 2 impact. So looking at the accounting treatment up the chain is very, very important. Now, many of our structured finance structures, there isn't a consolidation, but it's important to understand why that is. If it's on the basis of materiality, then that entity is still part of the M&E group. If it's because of investment entity status and this fair value accounting, well, that's different then. It's not part of the M&E group. But it is really important to dig into the accounting. And that's something else that we're doing for clients at the moment, is just really trying to understand what is the ultimate parent entity for the purposes of the rule, and just to make sure that there is no Pillar 2 implication.
Cool. Thanks, Patricia. So definitely an interaction between the tax and accounting there, and really important to understand that in assessing whether or not we're even in scope. I'm conscious of time, guys. I think we're pretty much done. So just to close out, there's obviously a lot there from a structured finance perspective in the bill. I think Pillar 2 alone would have been plenty, but there's obviously a lot more there for structured finance clients to be aware of, particularly around the outbound payments, and you've got some VAT changes there as well, and the qualifying financing companies, and a few other technical amendments which are just important to be aware of. So I guess the key is to get to grips with the new rules and understand the impact, I guess, on existing structures and also new transactions. And also bear in mind that some of the rules, like the outbound, for example, do have some level of grandfathering, which means there's some more time to assess the impact on those structures in advance of them actually going live. Finally, I'd like to thank everyone for joining the session this morning. I really hope you found it informative and helpful. And please do reach out to any of your standard EY contacts to the extent there's any follow-up questions. I know we covered a lot of ground this morning in kind of short order. But do reach out if you have any follow-up questions, and we're happy to talk through those. Otherwise, thanks again for joining, and enjoy the rest of your day, and we'll talk again soon. Thank you all.
Thanks, everybody. Bye-bye.
Bye-bye.